The last reported trade price for OpenDoor Technologies, Inc., ticker symbol OPEN, was $7.70 as of 1 p.m. EST on November 28, 2025. This represented a decline of $0.08, or about minus 1.03% from the previous close, trading on a daily volume that was already over 55 million shares. Now, if you're watching the pre-market activity or seeing the closing price from the end of the last week and thinking this is just another routine pullback in a volatile growth stock, you're missing the crucial and, frankly, far more interesting underlying tension. The consensus narrative, especially after the latest earnings report, is that OpenDoor is a distressed asset stuck in a punishing housing market, battling high interest rates, and a fundamental business model that looks deeply challenged when inventory costs soar. But the real story is what's happening beneath the surface. A sudden, aggressive injection of institutional conviction coupled with extreme short interest that sets the stage for a dramatic market event regardless of what the broader macroeconomy does next. What's fascinating here is the sheer institutional tug-of-war that has defined the stock's movement over the past few weeks, completely overriding the slightly disappointing Q3 2025 earnings call. While the company missed on its EPS and reported a net loss of $90 million, down from a gross profit in the prior year, the market's reaction was initially a sharp but brief drop. What followed was a highly volatile push upwards, fueled by notable filings. You see firms like Goldman Sachs increasing their stake by a staggering amount, a move that is not typical for a company whose fundamentals are supposedly eroding. Furthermore, the return of co-founders to key roles and a fresh $40 million internal investment alongside a shareholder-first dividend of tradable warrants designed to align management and shareholder interests provided a powerful, unexpected counter-narrative to the negative sentiment. This is the pivot that retail investors on forums like Reddit are keying into, the belief that the smart money is signaling a coming structural change, suggesting the worst of the iBuying model struggle with high inventory and interest rates might be priced in, or that their new, leaner AI-driven model is gaining traction much faster than expected. The volume surge accompanying these movements isn't just retail frenzy. It's a battleground for significant capital, and that's the real reason to pay close attention right now. The core business model of OpenDoor, which is to act as an instant home buyer or iBuyer, relies on quick, high-volume transactions to generate profit from the margin between the purchase price and the eventual resale price, augmented by ancillary services like mortgage and title. This model thrives in a low-rate, appreciating market where inventory turnover is fast and pricing risk is minimal. It was a true darling during the easy money days. However, when the macroeconomic environment flipped, with the Federal Reserve raising interest rates to combat inflation, freezing the housing market, and pushing inventory holding costs through the roof, OpenDoor's financial results understandably suffered. The Q3 report confirmed the pain: lower home sales volume, reduced gross profit, and a widening net loss year over year. The expectation is that this pain continues indefinitely, especially with mortgage rates remaining elevated. But here is where the deeper reality challenges that expectation. The company is aggressively implementing a new operating model, dubbed OpenDoor 2.0, which is heavily centered on software, AI, and disciplined underwriting. New CEO Kaz Najatian is pushing a shift from simply acquiring homes to prioritizing unit economics and faster sales velocity, even if it means smaller spreads initially. The recent insider activity is particularly telling. While there have been sales, key executives and co-founders have been making significant open market purchases, injecting confidence right as the stock was stabilizing from its prior lows. This kind of conviction from people who know the company's internal metrics and new strategy best is a strong signal that the leadership believes they have successfully navigated the worst of the housing cycle and are now optimizing for a new, more resilient business structure. The question for investors is whether this operational shift will actually translate into the promised adjusted net income profitability by the end of 2026, which is an ambitious goal given the current market climate, but is the stated goal. Now, let's talk about the elephant in the room: short selling pressure and how it complicates the simple bullish-bearish thesis. OpenDoor is a favorite target, sitting with a substantial short interest that hovers around 16.28% of the free float, according to the latest Nasdaq data. With a days-to-cover ratio of about 1.28, the market has enough volatility and potential buying interest to trigger a significant move if these short positions are forced to close quickly. The short thesis is straightforward and potent. The iBuying model is inherently flawed because it takes on unmanageable systematic real estate risk, and the company's lack of sustained profitability will eventually lead to capital exhaustion or further dilution. They point to the declining gross profit and the massive losses from prior periods. But the actionable insight for retail investors is to watch the borrow fee rates. While they are currently low, hovering under 1%, any sharp spike would be an immediate flashing red and green sign that short sellers are scrambling for shares, which would precede a short squeeze. Furthermore, tracking failed-to-deliver data can offer clues about settlement issues, although recent figures have not shown extreme levels, which is a common indicator of a coordinated attack or significant naked shorting. Retail investors can monitor FINRA data for off-exchange short volume, which has recently been running high, sometimes above 30% of total volume, confirming the consistent high-frequency shorting activity in the stock. For those tracking the action on social media, the debate is intense. On platforms like X and various retail investor subreddits, the stock is frequently discussed as a potential short squeeze candidate due to the high short interest and massive run-up from its 52-week lows. There's a strong coordinated effort to hold and push back against what many perceive as a bearish institutional assault. But retail needs to be smart about this. Chasing a short squeeze based on sentiment alone is a gamble, not a strategy. The responsible approach is to use the short interest data as a barometer of market vulnerability rather than a guaranteed catalyst. If a strong piece of positive news hits the wire, like a major institutional upgrade, a significantly smaller than expected Q4 loss, or an announcement of a new capital-light service that diversifies their risk, the high short interest acts as an accelerant, not the fuel. It's crucial to monitor the daily trading volume relative to the average volume. Sustained, higher than average volume could signal short covering. My question to you, the viewers, is: do you think the housing market has stabilized enough for OpenDoor's new AI-driven model to succeed, or are the short sellers, like D.E. Shaw, who filed for a significant 13G, simply smarter about the fundamental risks of this business? Comment below how many shares of OpenDoor Technologies you currently hold. Looking ahead, the future outlook for OpenDoor is tightly tied to both the macro environment and its internal execution. On the macro side, any signal from the Federal Reserve that rate hikes are fully paused or that a cut is in sight would immediately lower the cost of capital and inventory, acting as a massive tailwind. On the execution side, the company must prove that its new model can achieve that break-even adjusted net income goal by the end of 2026, which is the single most important catalyst to watch. We need to see quarters where the unit economics consistently improve, meaning higher contribution margins on each home sold and a clear reduction in operational expenses as a percentage of revenue, proving the efficiency of their new AI-driven approach. The recent warrant dividend and the insider buying are an attempt to align incentives, but actions speak louder than filings. The risk remains, as the consensus analyst rating is a sell, with an average price target that forecasts a substantial drop from the current trading price. The wide gap between the current stock price and the consensus target illustrates the tension. The market is betting on a future where the company is a scalable tech platform, while traditional analysts are valuing it as a deeply unprofitable, capital-intensive real estate company in a hostile environment. This stock is truly a speculation on a business model pivot succeeding against entrenched macroeconomic resistance. The immediate future hinges on Q4 guidance and how the company manages to execute on its promised inventory acquisition targets while keeping margins tight, a delicate balancing act that will either vindicate the retail enthusiasm or validate the short conviction. Ultimately, OpenDoor presents a stark choice: an expectation of continued real estate malaise or the reality of a technology-driven operational pivot that could make the iBuying model profitable even in a higher-rate world. The volatility is the sound of that uncertainty being resolved in real time.